This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
In this lecture, I'm going to go through chapter 23 of the paper F2 free lecture notes, and it's on investment appraisal, or some books call it capital budgeting. And what we're talking about when I say investment appraisal is investments in long-term assets, new machines, for example. The company's thinking of buying a new machine. Is it worth buying or isn't it? But it's that sort of investing, buying new capital equipment. And the most important, there are several ways in which you could go about making a decision, but by far the most important is to look at something called net present value, applying the discounting techniques that we dealt with in the previous chapter. Look at example 1 before I say any more. It says a new project will cost $80,000 and is expected to last 4 years, and at the end of 4 years it's expected to have a scrap value of $10,000. It's going to last 4 years. The scrap value, that's what we expect to sell it for in 4 years' time. The project's expected to generate operating cash flows each year as follows. Year 1, 20, year 2, 30, year 4, 40,000, 10,000. What we mean by operating cash flow are the profits, effectively, in cash terms. So whatever cash receipts we expect, our sales, less all our cash expenses. But we expect to get a net cash each year of 20, 30, 40, 10. We assume that the cash flows occur at the ends of years. There's interest at 10%. Either we're having to borrow money and it's costing us 10%, or maybe we've got the money already, it's in the bank, but it's earning interest at 10%. So either way round, putting 80,000 into this machine will be effectively costing us 10% a year. And our job is to decide, is it worth investing or not? And the net present value approach is basically terribly simple. We always look at the cash flows. We consider all future cash flows and only cash flows. We're not interested in things like depreciation. They're an accounting thing. We're looking at the cash that is involved. So here we pay out 80. We get back net cash each year of 20, 30 and so on. And basically, if overall, if we get a cash surplus, then it's worthwhile. We'll accept the machine, the investment, the project. So if we get back more cash than we pay out, it's worth doing. On the other hand, if there's a cash deficit, if we get back less cash than we're paying out, then we will reject the project. And here, if it weren't for one obvious problem, the decision would be obvious. Let's write down what the cash flows are. We expect to spend now 80,000. Now, we call that times 0. 0 is now. So we've got the original cost of 80,000. I put it in brackets, we're paying out 80. What are we going to get back? In 1 year's time, there's going to be net cash receipt. So it's all the cash receipts less the cash payments, but net cash of 20. An inflow. In 2 years' time, 30. In 3 years' time, 40. In 4 years' time, 10. And in addition, in 4 years' time, we're going to get the scrap money. After 4 years, we're going to scrap it for 10,000. So there's all the cash we expect to pay out and receive back. And I said, if we've a net cash surplus, we'll go ahead. And here have we. We get back 20, 50, 90, 100, 110. We're getting back 110,000. We're only paying out 80. There's a surplus of 30,000. And if it wasn't for one problem, we would therefore accept. The one problem, of course, is that there is this interest. That we're having to wait a year before we get back 20. We're having to wait 2 years before we get back 30. There is interest involved because, again, either we're having to borrow the money and we're paying interest at 10%, or we're taking money out of the bank that's earning interest and we're losing interest at 10%. What we need is the cash surplus or deficit after accounting for the interest. And the standard way we account for the interest is what we did in the previous chapter. For each of those receipts, we say, okay, it's 20,000 in a year's time. We work out the equivalent amount now. We remove interest, we discount to get the equivalent amount now. And so we did discounting in the previous chapter. Let's do it. The present values well, 80,000 now is 80,000, obviously. But what's the equivalent now to 20,000 a year's time? We discount. We multiply by the discount factor from the present value table. The interest is 10%. And so make sure you're on the right tables. The present value, the discount factor at 10% for 1 year is 0.909. And so 20,000 a year is equivalent to 18,180 now. Again, we're effectively removing the interest. Similarly, 30,000 in 2 years. Multiply by the 2-year discount factor at 10%, which is 0.826. 30,000 times 0.826 is 24,780. For 3 years, the factor is 0.751. 40,000 times 0.751 is 30,040. And 4 years, the discount factor is 0.683. Well, I may as well do those two together. There's a total of 20,000 in 4 years' time. 20,000 times 0.683 is 13,660. So by discounting, we've stripped out the interest cost, and we're saying, right, it's equivalent to paying 80 now and getting back 18,180, 24,780, and so on now. And so what's the net result? Is there now a net surplus or deficit? The net present value. $18,180 plus 24,780, 30,040, 13,660 minus 80,000. It's 6,660. That is a surplus. It's positive. And because there's a surplus, positive, which is a surplus cash, means we will accept the project. So the mechanics, again, we dealt with in the previous chapter. We know how to discount. Remember, if it had been an equal cash flow each year, then instead of discounting each year, we could have used the annuity factor. We've done all that. But this net present value approach We're discounting. We're seeing, is there a surplus or deficit after removing the interest, after accounting for the interest? If it's positive, we accept. Had it been negative, we would reject. And of course, the surplus is a lot smaller than that I said at the beginning. If there was no interest, we're getting back a total of 110. There's a surplus of 30,000. But after accounting for the interest, the net present value here is a surplus, but it's 6660. Okay, just one thing there. In real life, of course, all those cash flows would be estimates. We haven't bought the machine yet, so we estimate we'll get 20 in a year, 30 in 2 years, and so on. And that's a problem. It's something we'll deal with when you come to paper F9, in fact. But another problem is that even if I was certain of those cash flows, the rate of interest we're using. And again, although you're not concerned for paper F2, you'll see when you come to paper F9 that it's actually impossible in real life for a company to know exactly what the rate of interest is going to be. Because a company borrows from lots of different places. It's not simply borrow from the bank and pay 10%. And so all we'd really know is that, we think it's about 10%. But the problem is, suppose we were wrong. Just suppose the interest was 12%. Would that make this project better or worse? Well, think about it. If you're having to pay more interest, surely you'll end up with a lower surplus. And provided there's still a surplus, we're okay. But if the interest was higher and we ended up with a negative net present value, then, of course, we'd have a problem we should be rejecting. And so what's going to happen is the higher the rate of interest, the lower the net present value will be. And again, provided it's positive, we're okay, even if it's just +1. But if ever we ended up negative, even if it's just -1, then we have a problem. And so it could be very interesting to know how high can the interest be before we hit a problem. Well, remember, if this is positive, we're okay. Once it goes negative, we're not. The sort of break-even position will be a net present value of 0. And so the second thing you can be asked is mentioned on the next page. It's something called the internal rate of return. Or the IRR, which I always think is a dreadful name because it's not really a rate of return at all. The definition of it, the internal rate of return, is the rate of interest at which the net present value will be 0. Now, how are we going to calculate? For our project, example 1, we know that at 10%, the net present value is positive, but I want to know at what rate of interest will the net present value be 0? Well, there's no, what you might call quick way, there's no formula. All we can do is guess. Look at example 2. It says, for the project in example 1, let's guess, let's calculate the net present value if the interest was 15% and see what happens. So let's have a go. And in fact, what would be useful for you is, instead of just watching me do it, would be to pause the lecture, do it yourself, and then switch back on and check. But it's the same project, so we know the flows. There's an outflow, the original cost. of 80,000. Net cash inflows of 20 in 1 year, 30 in 2 years, 40 in 3 years, 10 in 4 years, and then another 10 in 4 years because we're scrapping it. The question's told us to calculate the NPV at 15%. So we'll discount in the normal way, but at 15%. So 80,000 now is 80,000. The discount factors, 15% for 1 year is 0.87. For 2 years, 0.756. For 3 years, 0.658. For 4 years, 0.572. And the present value is 20 times 0.87, 17,400. 30 times 0.756, 22,680. 40 times 0.658, 26,320. And finally, a total of 20 in the 4th year times 0.572 is 11,440. And so what's the net present value at 15%? 17,400 plus 22,680, 26,320, 11,440 minus 80,000. It's minus 2,160. Now, it's lower, as you'd expect, higher rates of interest, lower net present value. So if interest at 10%, we got plus 6,660. Interest at 15% made it a lot worse. It was minus 2,160. But what I want to know, this internal rate of return, is at what rate of interest would it be 0? And I think it should be clear to you that it's going to be somewhere between 10 and 15. So what we could do is keep guessing, and let's guess at 13%, let's guess at 12%, and so on. But you'll never be expected to with the exam. Having got those two values, we've got the NPV at 10% and at 15%, we can then estimate the internal rate of return. Now watch me carefully here. Some people learn a formula which I hate, because you're not given the formula in the exam. And although the formula works, there can be situations when you risk getting confused. If you want a formula, I'm afraid you're going to have to look to a study text. But if you watch me carefully, you don't actually need to learn a formula. Once you see what we're doing, you don't need a formula at all. It's easy. What's happened here? We worked out the NPV at 10% in example 1. And we got plus 6660. We then did it at 15%. And we got minus 2160. And so what's happened here? Over a change of 5 percentages, from 10 to 15, the net present value fell from plus 6,000 to minus 2,000. I'll put the exact figure in a minute, but it went from plus 6 to minus 2. It fell by 8,000. How much did it fall by exactly? 6660 down to minus 2160. It fell by 8,820. Plus 6 down to minus 2, fell by 8,820. Well, now we can write the internal rate of return down almost immediately. The internal rate of return, now remember, I want the NPV to be 0. We know it's more than 10%. But how much more than 10? Now, this is the bit to think carefully. I want, at 10%, the NPV was 6660. To get to 0, I need it to fall by 6660. If it goes down 6,000, we'll get to 0. Well, I know that 8,000 is 5%. So if 8,000 is 5%, 6,000 is 6/8. Is that fraction of 5%? 6660 over 8820 times 5%. Now think about that. You see, we know that 8,000 is 5 percentages. To get to 0, we need a fall of 6,000. Well, if 8,000 is 5%, 6,000 is 6 divided by 8 times 5%. And therefore, the internal rate of return is 10% plus 3.78%, which is 13.78. Now, I have a few things to say about that before I leave it. But please, if you've got that, great. If you haven't, watch it again, because once you've got the idea of it, it is easy. And I just think it's awful to learn a formula. The formula looks awful. In fact, it's just putting all that in symbols. But it's just messing around. It's not needed. And of course, you're not given the formula in the exam. All right, a few things about that. Firstly, although I've written 13.78, usually, I mean, you have to look at the choices of answers, whether how many decimal places. But usually we would simply say about 14, because in fact this is only approximate. What happens if you drew a graph showing the NPV against the rate of interest? You will find, that's 0, you will find that actually it's a curve. Now, if you don't believe me, you can have a go at home, when I'm finished, discount that project at 1%, 2%, 3%, 4%, 5%, and plot them on a graph. You will find you get a curve. And what we've done, we took 10% and got 6660. We took 15% and got minus 2160, and we've effectively treated it as a straight line. Now it looks very close there, but in fact our answer will only ever be approximate, because again it is a curve, it's not a straight line. So be aware of that. That's not a problem for you in the exam, but do be aware that it's really only approximately 13.78, which is why we would normally say about 14. Secondly, because of that, do appreciate, here I did a 10% and 15% because the question told us to, and in the exam you'd probably be told to. But in fact, any two guesses, we could have done, if the question hadn't told us, we could have done 10% and 16%. And then approximated the way I've done there. Finally, the relevance of it. I said in our example, we thought the cost of money was 10% and we would accept. But in fact, we now know that provided interest is less than 13.78%. Well, if there's 13.78, if the interest is lower, the NPV will be positive, and we'll accept. And so it does give us what we might call a margin for error. We think it's 10%. We might be wrong. What happens if it's 11%? What happens if it's 12%? We're okay. We're okay, provided the rate of interest is less than 13.78, because the net present value will be positive. We're only scared if there's any chance it's more than 13.78. Okay, so that's NPV and IRR. They're the important ones. I will stop this lecture here, but we'll have a part 2 and look at something called the payback period, which is a little bit different. I'll have it as the second part of this rather than confuse them all together.